You've got to work hard for your success and have a steady presence. That's the secret. Kid Rock, one of the hardest working guys in show business, and Kid Rock lays it out for us. You work hard, you have a steady presence, you do it day after day after day. 10 to 15 minutes is all we ask here. That is the secret. Following these charts, learning the nuances, learning the little things, becoming intimate with the ETFs and or stocks that you follow. That is so important. It is not spending 3 and 4 hours a night, because that won't last. It's hard enough to get people to just pay attention 10 to 15 minutes a day. Keep it up doggedly day after day after day. It will pay dividends. Again, you will see the kind of stuff coming that, of course, we have seen coming when that market rolled over and we had the weekly vertical crossover going down. Had a great time today on the phone. I guess it was about 45 minutes or so with Patreon supporters on our monthly question and answer. If you're a Patreon supporter and didn't make it to this one, be sure to make it to the next one. And I hope that all of you got the special training we put out yesterday on how to reduce your risk with order size. Very, very good. We'll have a special one for you today that's going out. And in fact, I'm going to record a couple of new ones after that. And it is about when indicators fail you, how to properly use them, and how to use the information you learn from them, good or bad, to make the most of your stock trends and the following that you do. Remember, folks, what we do here is all about trends. We do not mess around with trying to find anomalies in the market, inefficiencies, those kinds of things. We wait for established trends like we have in the S&P 500 and the Nasdaq 100 with these strong down moves. We see the S&P down 4.19% for the day. And no, I'm sorry, that's 4.91%. And the Q's down 4.36%. This isn't so good. We see 20-year bonds have also pulled back. We like to see bonds going in the opposite direction of stocks. The same with gold. Everything is down for the day. Of course, I've seen headlines such as the one in the New York Times today saying that the coronavirus is a pandemic. I've seen the other one that just came out from the Wall Street Journal saying we're now in a bear market. Just wait for the market to go up tomorrow. Just in response to that alone, we'll see. I'm not making a call here, but it wouldn't surprise me at all. But let's jump in, see where things are. Now, we have a support line that things are hanging out at. We pushed through that a little bit. That is an old support line that we had found. We just stuck it on there to see how well it was going to work. Look at the drop here in the price percent oscillator, dropping even at a steeper angle today. We're 3 days into a 5-day candle, plumbing down. It's the biggest down candle we have seen ever. I don't know. I don't know how far back I can go. I hadn't seen one this big in a while. Let's put it that way. It is a big down candle. Derivative oscillator also spiking down. Those who've been in a down trade, things are looking quite good, aren't they? 2-day chart. It also is going off the deep end, heading down. Now, remember, we had the latest 2-day candle finished drawing, the full one finished drawing on Tuesday. This is the first day of the latest one. And of course, it is a down candle reaching a lower low. Also, the candle body not as big yet, but moving down. Price percent oscillator spiking down. Derivative oscillator is about flat. Now, again, that's showing you that the leading indicator's leveling out a little bit. Price is well below the 2-day and the weekly trend lines. We go to the 4-hour chart. What do we see there? Well, of course, that 4-hour chart rotated over, going down on the morning of Monday. And what it has done is, if you jumped in on Monday afternoon, which would have been the time to do that, it is slid sideways over the course of the prior day. Again, all within the range of that prior big drop candle. In fact, within the range of the afternoon candle on Monday, and then started accelerating down today. So We saw it down in the morning, accelerating further down in the afternoon. Derivative oscillator losing some energy, but that price percent oscillator heading down. So keep your eye on things. Let's see what happens if we indeed do penetrate the line that we have for potential support. If that happens, we may see further drops. We may also see things bounce off that. So pay attention. If you jumped into that 4-hour practice trade, be willing to watch it and let those bigger indicators on the 2-day and the weekly continue to lead you. And remember, they are exceedingly down, but expect some volatility and some potential pullbacks. I guess we would call those pull-ups in the upward direction. If you jumped into something like SH, which is the inverse for the S&P 500, it's a single inverse. There are others, but this is one of the safer ones since it's a single inverse, not a double or a triple, anything crazy. But that's one thing for you to practice. If you haven't taken our training on inverse funds, how to make practice trades when markets crash, I very much encourage you to take that one. So this is where we are. Let's move away from the S&P 500 to the Nasdaq 100. Now the S&P was down the most, Nasdaq right there behind it. We see again going to the third week of strong down movement, plumbing lower lows, price percent oscillator dropping off at a steeper angle, derivative oscillator heading down. Go to the 2-day chart, also spiking down there. Now look at that, we've not reached a lower low than the prior day. That's why you see the derivative oscillator losing some downward momentum. The price percent oscillator is nonetheless spiking down, so keep your eye on that. That little wick has not, on the latest 2-day candle, has not reached a lower low than the prior. Now, this is just the first day. This candle will finish drawing on Thursday. Prices, of course, well below the 2-day and the weekly trend lines. Lastly, we go to the 4-hour chart. You can see that sideways slide. And again, that jumping in point was, again, on Monday at the end of the morning, early afternoon, slid sideways and then started moving down again on on Wednesday morning, accelerating in the afternoon. So we'll see how things continue to pick up. And again, with all the bad news coming in, look for the market to find anything it can to try to staunch some of these losses. Something also important to see, check out the 50-period moving average is being penetrated by this candle at this time. We haven't finished drawing the weekly chart yet. Let's see if we end the week with a penetration there. We'll continue to watch. Now, we're going to move away from stocks and go to bonds. Bonds blowing off some of that energy, but look at the candlestick still spiking well above the Bollinger Bands. Remember, things always come back into the Bollinger Bands. It will happen. We see the price percent oscillator flattening, derivative oscillator losing momentum. So again, still this weekly candle's being drawn, but we do see some blowing off of steam. We look at the 2-day chart. Check it out. Solid red down candle. First one we have seen in quite a while, since mid-February. After that huge pop-up, but see how things tend to come back to the norm. They fall back inside the Bollinger Band, Bollinger. I've been corrected on that. I appreciate it. I don't know where I came up with Bollinger. Perhaps that's correct. Maybe some of you guys know, but regardless, this band right here, it's come back in it. It's a volatility band, and we see that the 2-day chart has come back inside it. Now, this is just the first day. Price is sitting right above the 2-day trend line, well above the weekly price percent oscillator, heading down, but still positive. Derivative oscillator heading down, losing energy, but still positive. So let's watch and see how things go for bonds on Thursday and, of course, Friday. Now, check it out. We have finally had a crossover that happened in the morning, crossing over really into the afternoon. And what do we have? We've seen that the derivative oscillators flipped over, price percent oscillator heading down. The pullback is helpful. Why? If we see things bounce off the trend line, either one or both, and start heading back up while the 2-day and the weekly are still positive, guess what that gives you? gives you a chance to pull the trigger again to jump into a practice up trade on 20-year bonds. So let's watch, see what there is to see, and learn from this. Remember, you always want to look for opportunities to move back into trades in the direction of your largest chart, which is your weekly. Your 2-day has to be moving in the same direction. It could be a 2-day recross or a 4-hour recross. Whichever way it is, look for it, get ready to jump in and practice trade it. Okay, lastly, we go to gold. Gold down, also down the least, 0.36%. So again, just a little over 1/3% down. So just barely down. Have a green up candle for the week. But check out, we've just surpassed, just barely, the prior wick. Price percent oscillator is almost flat. Derivative oscillator's gone negative, our leading indicator has. So pay attention to that. Things are still positive but weak. Look at the 2-day chart. Hasn't crossed over yet, but it's getting closer. Derivative oscillator flipped over back on the 4th. The 2-day candle ending the 4th Wednesday, the 4th of March. So we'll see. We have a red spinning top right now, solid red. That means indecision tending down. It is above the weekly trend line, so we'll watch, pay attention to that. Go to the 4-hour chart. It too has crossed over. It did that back on Tuesday afternoon. So when gold crosses back over like it did back on the 4th in the afternoon, the 4th of March, you hopefully will see that happen again while the 2-day and the weekly are still positive. That'd be your point to jump in on a practice trade going up on gold. Now, these are possibilities, not saying they're going to happen, but be primed and ready to act if and when they do. And remember, it's all important in super volatile markets to consider lowering your practice trade order size to reduce your risk. Again, if your typical practice trade order size is $100,000, buying ETFs or maybe $5,000, buying whether you're going short or long on your options, then you might reduce the size down in half to reduce your risk. It's your overall money risk. It's not going to reduce the percentage of risk, of course not, but it will reduce your money risk. So keep that in mind. That's what that training was about yesterday. And again, don't forget the great training we have for you today. Sent out all the book orders. They've all been fulfilled. They all went out today. Thank you so much for your support buying the book, Charting Your Way to Wealth. If you don't have an autographed copy, we have one for you. Just follow the link in the show notes, and you can have one also. And again, if you're not a subscriber, go to chartingwealth.com, sign up, put in your name, email address for free. You will be getting all of those special trainings on a daily basis, and I'm about to record a few more for you. God bless, my friends. All the best from the whole team at Charting Wealth World Headquarters.